Thanks, Diane. Good morning, everyone. Thank you for having me here today. I'm glad that Toby clarified that was for the streaming. I did think it was going to be a dance floor, and I did not come prepared to do dancing, so I'm glad that's not for that. Today I'm going to talk about geopolitics. It is a huge topic in terms of all the things it covers. So it's strategic importance between economies and how they think about it. It's politics. It's those big shifts we've seen around the world. And obviously right now we're thinking around what it means for oil and energy markets. So I don't know if the team at IMAP had foresight on what was going to happen, but when I was asked to present about geopolitics about 5 weeks ago, this is not what I thought I'd be talking about. So it's somewhat on the fly. I would say that, that very kind introduction, my role is to think about markets. Is to think about asset allocation, what assets we like, on what time frame, and how we think about positioning in that. Obviously, geopolitics does form a part of that view, particularly as Diane mentioned there about the noise that comes into it, but it is becoming more relevant in terms of driving some bigger themes that we've seen playing out. So I want to focus a little bit more on those themes today and how that relates back to geopolitics, because it's something that's all-encompassing, and because it has been treated as noise, it's been treated as something that's viewed as either short-term, doesn't live through, or be something that can be ignored, and sometimes that leads to us being sort of being challenged around it and saying, aren't you being a little complacent towards these views as they come through? So I want to spend a couple of minutes just as a bit of a preamble thinking about those big shifts in terms of volatility that it does create, and really how it's not the thing that really drives the markets if we cast our mind back and think about some of those more painful periods when it comes to investing. So this chart here, the grey line, I understand it might be a little bit difficult to see in the back. The grey line is a geopolitical index by the Economic Policy Unit they put together. So basically just tracks when you see a lot of political change coming through, a lot of policy announcements, and how that impacts this index over time. The blue line is simply the VIX index, so obviously the volatility index for equities. And you can see that, the VIX index is often high when geopolitical risk is low, and you have these periodic spikes in that grey line. So you've got it during 9/11, obviously the Ukraine invasion, the tariff announcements, but in between those periods, you've got the Asian financial crisis, the European debt crisis, the GFC, all periods which created a lot more volatility in markets, were obviously deeply unpleasant when it came to thinking about investing, often came with dire economic impacts around recessions, and broadly, geopolitics is this thing that kind of just hums along and then it periodically spikes up. What you will notice, though, is that the relatively nearer term, you can see this grey line is getting sort of steeper, that it's becoming more prolific in terms of how often these events occur and how much we've seen that change. Now, this could be back down to some of the political dynamics in the US at the moment and over the last 8 or so years, but I think it is, again, coming back into these broader themes around some of the structural shifts I want to talk about in terms of energy security or decarbonisation, thinking around de-dollarization and the debasement trade, and obviously then thinking about deglobalization, the impact of tariffs and what that's having on trade as well, because those are big themes that come back to that geopolitical view, which are going to be something that we do think about as having a meaningful implication on correlations, as Diane mentioned, about putting portfolios together, but also opportunities that they present to terms of investing in. And then finally, I wanted to note that markets often panic first and think later. So somewhat coming back to the environment today, there's a lot of uncertainty around how long the Middle Eastern conflict is going to go through. And this is just to point out that markets aren't necessarily complacent. It comes back to this point around whether you think this particular geopolitical impact is going to change your view on where the world is heading. Does it change that big macroeconomic backdrop from something that's been, an ongoing recovery to something that moves into recession? Is it going to be something that materially downgrades earnings outlook for corporates or sees spreads widen in the credit markets? And often the answer to that is no. And that's why it's short-lived, and that's why it's something we tend to look through in terms of that portfolio construction impact, because the thing about geopolitics, as we're all well aware, it's virtually impossible to time. We don't know when these events are going to occur. We don't know how long they're going to last. But history tells us If it hits the energy market, those are the ones that are going to be more meaningful. So go back to the 70s, the oil embargo. You can think about the first Gulf War. That's where you had a prolonged impact in terms of the recovery coming through, where the market drew down the most, and where you actually see that knock-on effect to the rest of the economy, and obviously something that becomes local in nature quickly becoming global in its effect. So those ripples start moving around from that pebble that's been tossed in the pond. But overall, you can see on average, these are relatively short-lived events. They tend to only last a couple of weeks. The drawdown's not that big in terms of the median, and they return to recover quite quickly as well. So that's why we sort of advocate for not wanting to make big knee-jerk reactions when you do have these big events coming through, and tend to focus on what it means in terms of some of those broader themes that we do see shifting overall. Now, that was the preamble. I want to talk first about energy, that shift we're seeing, and really this relates back to energy security more than anything else. So local energy is secure energy. Renewables in that case makes it more secure. When you're thinking about where commodities are based around the world and the fact that you can't just sort of move them quickly from one place to the other, whether it's LNG or whether it's oil, obviously this is going to have a big driving impact. Thinking back to 2022 when we had obviously the Ukraine-Russia conflict, that was at a time when the economy was coming out of that period of COVID, where there was huge amounts of demand, and suddenly there was a supply restriction on the energy market. So you saw that big inflationary impact come through, and a big disruption in terms of those oil prices moving very high. That was all about pipes. That was all about moving gas and oil from Russia into Europe. This time it's about ships. It's all about how we get energy through the Strait of Hormuz into the rest of the world. And I'm sure you all know the stats. It's 20% of oil, it's 30% of seaborne oil, it's about 25% of natural gas that flow through the Strait of Hormuz. And obviously that's going to have a much wider economic impact because oil markets are very global in nature. So when we look at the flow of oil by destination, you can see the countries by absolute volumes that import it obviously are more Asian focused. So it's China, it's India, it's Korea, it's Japan, not really for Europe and the US. So it's a different dynamic this time. Things are much more persistent when it comes to the economic impact for the manufacturing hub of the world, which is Asia. And again, it's not always the same in terms of the economic impact of just thinking about absolute levels of oil that's coming through. We need to focus on how much of that oil is actually a share of imported energy. What is that overall in terms of the energy concentration in that economy? And places like China, while these numbers are high in absolute terms, are very low as a percentage of overall energy consumption because they have obviously coal, they have a lot of renewables, and they're kind of insulated from this effect to a degree. It's the rest of Asia. It's Korea, it's Japan. We have this big blue bar which shows you the share of oil imports overall that comes through the Strait of Hormuz that's going to be impacted. And if we think about natural gas, it's even sort of a little bit stronger because they're so reliant on natural gas for a lot of their energy imports. So this is where it becomes a little bit different in the dynamic in terms of thinking about that energy security and how these countries are going to play for it over time. The second thing I would just mention about this is that overall, the world is becoming less energy intensive or less reliant on fossil fuels, as we have seen some of the move towards renewables, as we have seen an improvement in terms of how we use that energy. Think about more efficient homes, more efficient manufacturing processes. So the shock should not necessarily be as large as it was, say, back in the 70s, but it still will be a shock. But this is an ongoing theme. We think about that evolution towards that energy security that was so critically important during 2022 and that Russian invasion of Ukraine relative to what we're seeing today, and amplifies that theme. So this is where we start to talk about those big themes around geopolitics that you can capture in the portfolio, which do influence how we think about how asset classes actually work together or not. And because it's a focus on energy security, it's a focus on defence, because obviously we've seen some of the ramifications of a pickup in these conflicts coming through and who is stepping in to try and reduce that conflict. Obviously thinking about the implications around NATO, the defence spending increase we're seeing there, and the commitments by governments to increase that from 2%, which they didn't often meet as a share of GDP, up towards 5% to 2030. And that really has changed the focus when we think about fiscal dominance around the world, that fiscal activism coming through. So this chart just shows you government debt as a share of GDP. Obviously at the top there we've got the US, they have a lot of debt, that's going to grow forward. These are just forecasts from the IMF and the OECD. You can see Germany down in the light blue line, Australia there in the dark blue line, and then China moving up higher as well. So there's a divergent story around the world, but basically all governments are spending more because they need better infrastructure, they need energy security, they're spending more on defence, and that's a really big change. Now, the focus is usually towards Europe because Europe had such a period of austerity that they just didn't spend that much. And actually, obviously, the impact of that was quite evident in terms of those low growth rates they have. You can look to the case now of, say, Greece or Italy or Spain. Why those economies are doing so well today relative to France and Germany? Because they went through that really painful period of deleveraging after the European debt crisis, and that's why they've had some of the best performing economies and markets until very recently. And this is perhaps best summed up by looking at just the investment during different periods. So prior to the GFC, you can see the blue is Eurozone, the grey is the US. They were roughly spending about the same. It was about, on an annualised basis, 5 to 6% of their GDP of government investment over time during that 5-year period. Post the GFC, it was only the US that's spending. The Eurozone went into that austerity, didn't spend, didn't invest in its economy, and paid the price. And then suddenly last year, a massive shift. And then projections out from COVID or 2022 to 2027, you can see those numbers are much higher than they were in the past. And again, more balance between the US and Europe. There was a really significant change this time last year where Germany came out and said, we have this thing in our constitution called the debt handbrake that limits the increase in spending as a share of GDP every year. We're getting rid of that. And there was a massive lift in bond yields, and everyone started to reprice that, exactly what you saw today or last night, overnight in the markets. And that's because they said, we're going to spend $1 trillion on defence and infrastructure over the coming decade, something you hadn't seen for a very, very long time in Germany. 500 billion of that was just going in infrastructure. And so they really leaned into the realisation that they needed secure energy, they needed to build and improve their defence spending. And there's obviously positive externalities, to use the economic term for that, in terms of GDP growth, in terms of productivity enhancements, as they uplift the whole infrastructure of the economy and into the broader European region. But that focus on fiscal, because of what we're seeing in the Middle East, because of what we're seeing in Ukraine, to build up that energy security, to focus on that defence, is a big consequence of these geopolitical impacts, which is going to have knock-on effects when it comes to thinking about what bond markets do, how we think about growth in those regions, how we think about the behaviour of equity, and importantly, what we saw play out really well last year, how we think about international diversification across equity markets and simply not thinking about US exceptionalism. That was the first one. The second thing that obviously economies are thinking about more and more and how they're focusing on it, especially again these surplus economies that export large to the world, is that we have a greater fragmentation in the global economy now. So tariffs and trade policy was the thing we all worried about. It was like, oh, this is going to create this inflation. It's going to be the thing that derails and sends us into a recession. And then thankfully there was, someone invaded someone in the Middle East and we talk about something else now. But it is a case of thinking about how this is still going to be a shift that continues on for a long period of time. This is just the average tariff rate on goods going into the US, going back to, that's 1900 at that very far side of the chart there. So over 120 years. And you can see that the number was about 2% for an exceptionally long time. You had freer trade. It makes sense from, when I studied economics university, if you make it good at making butter, you make butter. If you're good at making plastics, you make plastics, and then you trade the two. And that's really how you get to where you're going in terms of being a stronger economy. And then obviously we had that big shift coming through during President Trump's first term. It's this theme about nationalism, that when you had this unsettled populace, that when people weren't happy, they were wondering about their employment prospects. A lot of their industries they had been marginalised. You had that populism come through. Stronger in the US. Again, it's linked back some of this migration sort of policies we've seen come through, but not simply the US. You've seen it in Europe. To a degree, you've seen it in Australia as well. It's this movement away from thinking about a pushback on what has been a very globalised world and how countries are now focusing on themselves more and more. And this is just more evident through tariffs. So the peak of the tariff concern was back in April of last year, Liberation Day. Obviously, that 30% number didn't come to bear. Even when we had the International Emergencies Powers Act, where Donald Trump put in place all those reciprocal tariffs against economies. The average tariff rate was going to be 16%. Obviously, that's been struck down by the Supreme Court in America, and today the number is about 12%. So 12%, you have to go back all the way to just after World War II to see a number that high. It could come down a little bit from that because there's a lot of legal ramifications of what's still going on, but it's probably going to sit around 10 or 12% even after that, because they'll go through some other mechanisms to try and make sure it's there. So this is just saying that you're going to have, again, more fragmentation, that investment in domestic industries, because you can't export and grow your economy through exports to those old markets, is going to be very prevalent. And also thinking about that insurance of your population and your nationalism goal that's seen to come through, reliance on more of that strategic autonomy that we start to come through, and wanting to have dominance in certain areas such as AI and technology advancement all being produced locally rather than relying on global supply chains, is all something we think about more importantly as impacting not only just the outlook for growth, because this would on balance shave your growth forecast down because it becomes more fragmented, push up your inflation forecast as well, but only to a degree, because we do think about that reshuffling that comes through. So it could also limit the productivity we see around the world or the knowledge transfer. I think for us it is a case of thinking about this fragmentation that's coming through, that reshuffling of supply chains, not the ending of this growth. And we're not big believers in deglobalization, but certainly slowbalization. This is going to take a long time to play out, and it really hasn't come to bear immediately in terms of those very high inflation numbers that everyone expected to come through, but it's going to be the slow-moving trend as we think about more domestic production coming through and how that can add to that inflationary outlook overall. The reason we say that is because one of the goals that the US had around this was to address these unfair trade balances, or imbalances as they called them. So you can see the US trade deficit there on the far side of the page. The blue is China, the grey is the rest of the world. It's not getting smaller, I think is the point. That trade balance was meant to shrink as the rest of the world was meant to buy more stuff from the US than the other way around. And in fact, it's still very, very large. So obviously, that was because everyone tried to sell stuff to the US before the tariffs came in place, and that got larger, or because you've actually just seen where these goods come from just being moved around the world. There is a bit of a small shrinkage in the blue portion, which is China, and that's been offset what we've seen come through the rest of the world, where it's goods going through Mexico or Canada into the US, whether it's been a reshuffling around Asia that's come through. And that does make sense. I think the important point there is that trade is not really ending, it's just moving in how it comes through. And again, you can see this here in terms of the goods imported by market. The green line is China, and obviously China joined the WTO back in 2000, and then over time, as it captured market share, particularly around that manufacturing side of things from economies, that seemed to be something that was curbing growth in those markets, leading to that build-up in those populism and nationalism tendencies. And then after the initial trade war back in 2018, you've seen it start to slow down, obviously, but everywhere else is importing goods at a higher rate throughout the Asian region into the US. So it was Vietnam was a beneficiary of that. We've got Taiwan and South Korea, obviously consumer electronics, thinking about the inputs in the AI supply chain. It's just been this reshuffling of the growth story. Now, again, this is one of these geopolitical events that's linked back to those policy views, those nationalism views, trying to improve what is perceived as an unfair balance, and something we grappled with last year when they were announced, trying to figure out what it meant for the economy, what it meant for markets. That initial big drawdown we saw in April was quickly unwound as the news headlines changed, similar to what we're feeling today, where it does feel like the market trades the headline and how much we should rely on that or how much we should look through it. This is going to be a slow-burning one. It's going to be one that we can sort of look through to a degree, but at least because it's not moving quickly is something we can manage. So this is just a map that shows you trade flows around the world. The green and the yellow and the red of the arrows, it just represents whether the growth in trade between those regions this year compared to last year is growing, shrinking, or roughly the same. And you can see a couple of themes that have come through. So the two big red dots are obviously trade from Asia into North America and from North America into Asia. So that's where the challenge has been because you've had those tariffs and trade come through. What you have seen, though, is more interregional trade. So Asia to Asia trade has come up. When there was that concern in 2018 around those supply chains and that initial tariff war, what a lot of people do or companies do, China plus one strategies. They say, I can't rely just on China for my manufacturing and my goods export. I need to have another backup country where I can get those goods from to make sure my supply chain is resilient. And then they moved on to the next phase of that, was thinking, well, I'll broaden that out and I'll have multiple countries I can think of in terms of that supply chain resilience around the world. And that's gone into phase 3, where it's been a much more regional allocation towards that supply chain resilience coming through, or even moving that supply chain closer to the end consumer in these growing markets overall. So again, the illustration here is to show you that while this trade is challenged between two of these very large parts of the world, you're seeing greater inter-regional trade, whether it's in Europe or whether it's in Asia, or whether it's in Asia into Europe, as they pursue, again, some of those strategic goals around renewables, energy security coming through. And so the fragmentation is not within regions, it's between those regions that really matter. And again, you're seeing some of those sort of alliances start to form between certain countries based on their political leaning, which becomes more important over time. But broadly, global trade is still increasing overall. And in fact, when we look at global trade in terms of absolute numbers, in terms of the distance these things travel in ton miles, whether it's oil, whether it's dry bulk, whether it's containers, this thing just keeps going up. There's no shortage of demand for goods around the world, for energy around the world. It's just moving further as they have to navigate these new supply routes, as they have to think about certain parts of the world they can't travel through anymore. But as this distance traveled goes up, it does again mean the cost of those goods perhaps goes up. There might be an inflationary consequence to this. There could be an investment consequence to us, because you still need trade. How's it being moved? On boats, on ships, on aircraft. There's still a need for that transport to move these things around the world, because it is such an integral part of thinking about how the global economy continues to operate overall. So trade and tariffs, something that can be both inflationary, we want to think about that, some of that fiscal response that can be inflationary, but also create opportunities, as we've seen them move into energy and defence, and thinking about building out that infrastructure that leads to better economic productivity in the economy, which can boost earnings. And then thinking around the prospects for some of these physical assets that go with this, whether it's ships, whether it's aircraft, whether it's ports. The need to have a lot of that energy infrastructure built locally creates a lot of opportunity if we think about the underinvestment we've seen across infrastructure in many parts of the world for a long period of time. Finally, in terms of that third one, if it was about energy, if it was about trade and tariffs and deglobalization, one of the bigger consequences I think a lot of people are grappling with in terms of portfolios is that, at times when there is pressure in the markets, there should be these safe havens we can lean on, that we can trust, that provide that diversification within a portfolio. And the US dollar was one that was challenged about whether it would work. Would there be this flight to safety? Certainly not in the treasury market so much we've seen with this latest episode. Still with the US dollar to a degree, but perhaps not as strong as many people would think it would be. And this is back to this idea around de-dollarization. The world is moving away from being one that is reliant on the US dollar as the reserve currency. Now, that's not as far as we would go. We would talk about debasement, which is just this case undermining of the value of the US dollar, which is a slow-moving trend. But it's very hard to think about de-dollarization when we don't have a clear replacement for what would be the international currency overall. So, there was periods of time when it was meant to be the euro. People talked about whether it would be the Chinese renminbi. Again, there hasn't been either the institutional bandwidth or the fiscal bandwidth in the Eurozone to make that work. There's been the lack of convertibility with the Chinese currency to make that work. The rule of law is not strong in China as it is in the US, which really underpins the US dollar as something that can be the global currency for the whole world. And so it is a case of thinking around that debasement merely being a function of some of those concerns around the institutional strength of the Federal Reserve and its independence, that growing fiscal debt pile that people start to worry about being able to be paid back in the future. Some of this political noise that comes out that makes investors not want to have so much exposure to perhaps US assets, or maybe still US assets, but maybe not the currency, which tends to capture a lot of those volatility and fluctuations in the near term. And the reason we say that the US dollar still has that role as the world's financial currency, as the source of main way we trade commerce around the world, is you can see that it dominates so many different things, whether it's emerging market debt, SWIFT payments, currency debt, foreign exchange, trade invoicing. That grey bar is all US dollar. It's all between 50 and 70% of these functions. It is still the thing that underpins global commerce. Global foreign exchange reserves is the one I would point out. So it's about 58-59% of foreign exchange reserves are held in US dollars. Go back to 2020, so 25 years ago, that number was 70. So there is this slow movement away from the US dollar, but it is very, very slow. So when we think about that idea of de-dollarization to move away from this could happen, but it could happen in the next 40 years, not the next 5 or 10, which is typically a medium to longer term time frame thinking about investing. So it's something that's going to be a very slow moving and a longer term trend, but it's something that is there to a degree. And it is something that we think about being more meaningful in terms of the currencies that have benefited. As that foreign currency reserve number has come down, obviously the Chinese renminbi has gone up a little bit, it's about 3%, but the Australian dollar, Canadian dollar, these other perceived safe currencies have also increased in terms of their holdings at FX reserves as well. So it's just that broader diversification. And then there's also gold, which I'll come on to in a minute. We have seen this move away from wanting to own US assets, though, and we look at this in terms of foreign US Treasury holdings. So, again, a common question when it comes to geopolitics is that, well, you have all these big official institutions, which are basically sovereign wealth funds and central banks that have a large exposure to US Treasuries. What happens if they were to turn around and sell them and put that pressure on the US or use them as that political tool? Now, there has been a decline in foreign treasury holdings, which suggests this is something that, could be perceived, but it's not a collapsing. So those numbers on that scale, it's 35% down to about 25%. It's still above where it was back in the 2000s, early 2000s. So it's not a meaningful shift away. And it's more on the official side than anything else. Again, it's been that rotation for central banks to want to own something that's not the US dollars as they think about that value being eroded, that debasement coming through. It is sovereign wealth funds in certain economies have moved away from it to a degree. Obviously, you can think about many emerging markets where they've looked at the experience within Russia and Ukraine and seen the use of the US dollar to put in place sanctions and create some of that financial pressure on the economy and not wanting to have that. So they've reduced that exposure to the dollar. But then there's others. This little table, apologies, it's a bit hard back to see from the bottom back of the room, but the European Union has almost doubled its holding of US foreign treasuries over the last decade. UK has tripled it over time. So those allies, if you want to call them that, of the US, are still buying these treasuries. And this is the official holdings. We often think about the private market as well. You maybe look at your own portfolios or think about investing or you're doing on behalf of your clients, the exposure you have to US credit, the exposure you have to US treasuries, the exposure you have to US equities, all means that you have exposure to the US dollar by and large, unless you're hedging it all out. So there is still on the private side an increase in that exposure over time. So you're not seeing a wholesale move away from by private investors to owning these US assets. It's more on the political realm. And again, it's not collapsing. So we don't think about this being something that's drawn away, or we don't think about necessarily it's something that's suddenly going to say funding costs for the US government are going to escalate massively because all those foreign holders are going to sell their allocations overall. It is something worth bearing in mind, though, when we think about the role of the dollar over the long term. And that role is for that depreciation to continue. While we have seen it be supported as a safe haven right now, more importantly, over the long run, that debasement trade is going to keep going. It does mean we think about the impact of a declining US dollar over a longer period of time, the importance of hedging that risk in a portfolio over a longer period of time, and taking out some of that currency volatility that could be more apparent when we have these periods of shocks, because the US dollar, while it is acting as a little bit of a safe haven, the strength of that is not necessarily as strong as it has been in the past. Obviously, the bigger one is around fixed income. If we talk about the outlook for hedges or outlook for diversification and benefits of that in portfolio, a more fiscally orientated economy, a more fragmented economy, one we're thinking about more of that friction that comes through from global trade that's not as easy as it was before. All this leads to investors thinking about pricing in more of a term premium, thinking about higher compensation for lending money to governments overall. And you can see that term premium has been rising in the US ever since COVID as we think about that fiscal response, that change we've seen in governments. That does mean we get steeper curves by and large over time, that we get higher bond yields. Now, that may seem like a negative it's actually a positive because you're getting a higher bond yield. You're getting a yield curve that's sleeping upwards, so you're getting paid to take longer duration, and obviously thinking about what that means in terms of the returns on those yields over time or those fixed income over time, as that compounding effect actually lifts that return from portfolio. So we do think that fixed income still has that role in a portfolio as a diversifier when we don't have these periods of stress. That, as that chart showed you at the right start, those volatility spikes that come through are short and sharp, and so most of the time the diversification of benefit fixed income is still there. When it comes to things like gold and those other diversifiers, I do think gold has gone through a bit of a regime shift. I understand, IMAP's been speaking with the World Gold Council, so I won't dwell on this for too many minutes, but you can see that the gold price has gone through these periods of 70s when stagflation, that was the Iranian conflict, we had the oil price shoot up back there. Stagflation concerns saw it rise, didn't do much for most of the 80s. Then we had falling real interest rates, so the outcome of the GFC, quantitative easing, driving down of long-term rates and higher inflation, obviously meant we just had falling real rates, and now it's fiscal concerns and geopolitics. So gold does have more of a role in a portfolio than it has in the past. That central bank buying, as they've diversified away their holdings, has been quite prevalent. That pace of change is probably not going to be that much as in the future, but if they have to keep that share stable, there's still going to be big buyers of gold. And we know the gold supply only goes up by about 1% a year, so that demand is likely to outstrip that supply. And so we do think about gold having more of a role in a portfolio to hedge out some of that risk. I would stress that volatility of gold is similar to equities, so we think about it being something that works in a time of stress relative to a time of calm. But again, a natural way to think about greater diversification of portfolio. But we would tend to think about alternatives being one of the key better diversifiers, particularly on the real assets side. So infrastructure, transport, real assets like real estate, where you get both that inflation protection coming through in terms of being linked back to the levels of inflation in the economy through contracts, as well as thinking about that defensive nature of that yield, with assets that are very much linked to the economy, which aren't going to be sensitive to those GDP movements overall as much. So here we can see the trailing correlation between a 60-40 portfolio and these assets. And so everything to that side of the page basically diversifies your portfolio very more. Everything to this side of the page is less diversified, so PE, private credit. And that's where we see the greatest demand when we talk to many of our investors about what they're trying to build into their portfolios, because they've looked back and said 2022 was both a time when stocks and bonds didn't work. I feel like this is what's happening at the moment as we start to think about stagflationary concerns. These are the things I need to add to my portfolio. And when we do our long-term capital market assumptions and look forward about our returns over many assets over the next 10 to 15 years, what we found is that if you build up the amount of real assets alternatives in your portfolio from a 60-40 portfolio to one that has a 30% allocation to alternatives, it increases your risk-adjusted return by about 25%. So improves your return, lowers your volatility, and drives that decision to have those assets within your portfolio. So I want to finish with a couple of not condescending pieces, but very obvious pieces when it comes to thinking about portfolio construction. The first is diversification is your best defense. So just a periodic table showing your asset class returns over time. Who knows from one year to the top, the bottom, it's a bit of a mixed bag when it comes through, but the portfolio in the middle, this is just a hypothetical portfolio I've put in, is the one that really matters for investors. You can go back in any of those years and find a reason that something would have gone wrong in the market. It's easy to do that, whether it's a geopolitical event, an economic event, or anything else, but over time you still see this portfolio is delivering you 7% for around about 9% volatility, and that's the focus. The second thing I'll leave you with this is that movement towards cash, and we've seen a lot of that at the moment. It's great for liquidity, for allocating when things get better. It's not the reason or the thing we hold as a defensive asset in these periods, particularly when geopolitics is rearing its ugly head. You can see that these events are all geopolitical events from the Gulf War back in the 90s all the way through the Russian-Ukraine invasion. The green is the cash rate. This measures the performance of a 60-40 portfolio over cash over a 1 and 3 year time frame after that event has taken place. So assuming you invest in the month before the event, so you didn't know it was going to happen, and then what happens over the following 12 months. So you can see of the 12 events, there's only 3 grey negative bars. It means that 75% of the time, that 60-40 portfolio outperform cash over a 1-year time frame, and 100% of the time it does it over a 3-year time frame. So that's the green bar. So cash is not the way that you're going to build in either your objective returns or thinking about how you're going to have more defence in your portfolio, because again, the short-term nature of a lot of these geopolitical events makes that very difficult. Thinking about those longer-term themes is what we want to focus on in terms of that energy security, that defence, that fragmentation, the globalisation, or thinking about the role of the dollar in a portfolio. And I'll just finally finish you with a few summary points there. I think I'm going to steal this line that I heard my boss say, which I think is a very good one. You hedge the risks you can see. You can buy oil futures, you can buy energy stocks, you can do relative value trades, you can buy US dollars to hedge out risks that you can see right now. You can't hedge risks you don't see. And that's geopolitics in the future. What you do to overcome that is diversify and build that robust portfolio with the appropriate asset mix that you have. And so you diversify for the future for those risks you can't see. So thank you very much for your time and listening today. We might have 1 minute for a question or two, I think. But I did enjoy the rest of the sessions. And again, thank you very much.
Thank you so much, Kerry. Look, we do have 1 minute if there is any burning questions for Kerry. There's obviously so much to talk about in terms of geopolitics and its impact on portfolios. Please wait till we get a microphone to you so that we can pick you up on the streaming. Has anyone got a question?
I have a question, Kerry, which is, you talked about de-dollarisation. What do you think are the things that might lead countries to prefer other asset or other currencies, and more to the point, what is that other currency?
So I think the thing that allows that to happen, a really quick short answer, is the ability to actually transact those countries. So one of the bars on the top of that chart was SWIFT payments. So the US dominates in the ability to actually transact those currencies and that payments around the world. You've seen China try to build its own one. You've seen more convertibility between, say, the Saudi Rial and the Chinese currency. So it's all about the convertibility of those currencies, which makes a movement away from the US dollar more appealing. And so that's where you've seen those things come through. Stable coins, things like that could be something that comes up in the future as being a metric to do that. Obviously, there's a big focus on the use of those payments relative to the currencies. I think there's a long road before you get there in that one, but I think it'll be more around how easy it is to convert those other currencies, which is be the big driver, and those technical payment systems which allow that, where those are dominated by the US at the moment. So those are the things I would watch. And one final thing, I'm definitely not an expert in geopolitics. We do have those in JP Morgan. We have a geopolitical centre and a man called Derek Chalet, who publishes lots of newsletters and thoughts around what's happening in the markets at the moment. You can sign up for that on the JP Morgan website and get his latest views as well, should you want them.
Amazing.
Thanks, man.
Join me in thanking Kerry.